Okay, imagine this. You've been saving, investing, doing all the right things for years, decades even.
Right.
But then you look closer, run the numbers, and realize just where you put that money, well, it cost you maybe $600,000 extra in taxes.
Wow.
Compared to someone else who invested the exact same amount, got the same growth, but just used different types of accounts. And that's not made up. It's based on a real calculation someone shared. It shows just how massive the impact of the account type itself can be.
It's huge. And it's something we talk a lot about what to invest in: stocks, bonds, mutual funds, whatever.
For allocation.
Exactly, allocation. But the location, the type of account you hold those investments in, it's just as critical, maybe even more so over the long haul, especially here in the U.S. with our tax system.
That choice between, say, a regular brokerage account and something like a 401k or an IRA.
Yeah, that fundamental choice. It's honestly one of the biggest financial decisions you'll make.
And that's really what we're digging into today, isn't it? This whole question for U.S. investors. How do you strategically decide where your money should live? What is a real difference between that standard taxable brokerage account and these tax-advantaged ones?
Right. We're trying to unpack that. And we've looked at quite a bit, some basic explanations of the rules, the definitions.
Foundational stuff.
Yeah. But also really interesting discussions from places like Reddit, the Bogleheads and personal finance forums, where people are actually sharing their own experiences, their own math.
Real-world examples.
Exactly. And some solid info from financial education sites, too.
So the mission here is really to get a handle on asset location. It's like the twin sister of asset allocation, right?
That's a great way to put it. Allocation is deciding, okay, 80% stocks, 20% bonds.
Location is, where do those specific stocks and bonds go? Which one's in the taxable account, which in the traditional 401k, which in the Roth IRA?
Precisely. And the goal is usually tax efficiency. How do you use the different rules of these accounts to minimize the drag that taxes create on your investment growth?
To ultimately end up with more money over time.
That's the idea. Maximize your wealth by minimizing the tax bite.
Okay, so let's lay out the playing field. We've got taxable accounts on one side.
And non-taxable or tax-advantaged accounts on the other.
Let's start with the taxable ones. What exactly is a taxable brokerage account?
Think of it as your standard default investment account. If you go online or to a broker and just open an account to buy stocks or funds, and it's not specifically labeled an IRA or a 401k or something similar,
it's probably taxable.
Almost certainly. And the name says it, all the investments inside are subject to taxes.
And this happens kind of automatically year after year.
Pretty much.
Yeah.
The key thing is, any income, the investments generate dividends from stocks, interest from bonds, you get taxed on that in the year you receive it.
Whether you spend it or reinvest it.
Doesn't matter. If your bond fund pays out interest or your stock fund pays dividends, you'll get a tax form, usually a 1099, listing that income, and you owe tax on it.
And that's typically taxed at your ordinary income rate.
Yes. Dividends and interest in a taxable account usually hit you at your regular income tax rate.
Which can be pretty high for a lot of people, much higher than specific investment tax rates.
Definitely. And then there's the other piece, capital gains. If you sell something for more than you paid,
you have a gain.
Right. And in a taxable account, you pay tax on that gain in the year you sell. How much tax depends on how long you held it.
Short-term versus long-term.
Exactly. Hold it a year or less, sell for a profit, that's a short-term gain, taxed just like your regular income.
Ouch.
Yeah. But if you hold it for more than a year, it becomes a long-term capital gain. And those are generally taxed at lower rates.
The preferential rate's 0%, 15%, 20%, depending on your income.
Correct. So there's an incentive to hold investments longer in a taxable account.
Okay, so the downside seems clear for long-term growth. You've got potential taxes hitting you every year on dividends and interest, plus taxes when you sell at a gain. Kind of chips away at things.
That's the main drag, the tax drag we'll talk more about. You have these ongoing tax liabilities you need to track and pay. But, and this is a big but,
there has to be an upside, right?
The huge upside is flexibility, liquidity. You can put money in, take money out, sell whenever you want for any reason, no IRS penalties for accessing your own money.
Ah, okay. So that makes it the go-to for shorter-term goals, things where you know you'll need the cash before retirement age.
Absolutely. Saving for a down payment in 5 years, a car in 2. You need that penalty-free access. You don't want to be locked up until age 59 and a half.
Makes sense.
Yeah.
Though for really short stuff or emergencies, Maybe just cash or a high-yield savings account is better. Less market risk.
Oh, definitely. Emergency funds shouldn't be invested, full stop. They need to be safe and accessible. But for goals a few years out, taxable accounts offer that blend of potential growth and liquidity.
Okay, that clarifies taxable accounts. Now, let's flip to the other side, the non-taxable or tax-advantaged accounts.
Right. These are the special accounts set up with tax benefits, usually encouraged by the government to get people saving for retirement or education.
Like the 401k at work or an IRA you open yourself.
Exactly. 401ks, 403bs, traditional IRAs, Roth IRAs. There are others too, like SEP IRAs, simple IRAs for smaller businesses, 529 plans for college savings. But the main retirement ones are 401ks and IRAs for most people.
And the core benefit here is different, right? It's about how the growth is treated inside the account.
That's the magic. Dividends, interest, capital gains that happen inside the account, they're not taxed each year like in a taxable account.
For any of them, traditional or Roth.
For all of them, that internal growth is sheltered from annual taxes. The difference between them is about when the tax happens or if.
Okay, break that down. Traditional versus Roth. That seems like a key decision.
It is. With traditional accounts like a traditional 401k or a traditional IRA, the money you put in might be tax deductible now.
So it lowers your taxable income this year.
Correct. You get a tax break today. Then the money grows inside the account, tax deferred. All those dividends, interest, gains pile up without taxes being taken out each year.
Deferred, meaning you pay later.
Exactly. When you take the money out in retirement, both your original contributions, if they were deductible, and all the growth are taxed as ordinary income.
So tax break now, tax-free growth inside, pay tax on withdrawal.
That's the traditional deal. Now, Roth IRA, Roth 401k flips it.
Okay.
You contribute money you've already paid taxes on. There's no upfront tax deduction. Your contributions are after tax.
So no tax break now.
Right. But the payoff comes later. The money grows completely tax-free. And when you take qualified withdrawals in retirement,
You're tax-free too.
they're completely tax-free, contributions and earnings.
Wow. Okay, never paying tax on potentially decades of growth sounds amazing.
It's incredibly powerful. The trade-off is you give up that tax deduction today that you might get with a traditional account.
So you're choosing pay tax on the seed money now, Roth, or pay tax on the whole harvest later, traditional.
That's a perfect analogy. And which is better often depends on whether you think your tax rate will be higher now or in retirement. We'll definitely circle back to that.
You mentioned a change with Roth 401ks recently, Secure Act 2.0.
Yeah, it's a bit technical, but there's a provision currently on hold, but plan that for higher earners making catch-up contributions, those extra amounts you can put in when you're 50 or older,
Yeah.
they might have to go into the Roth 401k side after tax. It just shows these rules can get complicated and change over time.
Good to know. So apart from taxes, what are the general characteristics of these tax-advantaged accounts?
Well, they're really built for the long term, mostly retirement. Because the government gives these tax breaks, they generally don't want you pulling the money out early for just anything.
So restrictions on withdrawals.
Usually, yes. The big one is the potential 10% penalty if you withdraw funds before age 59 and a half. That's on top of any regular income tax you'd owe on pre-tax money or earnings.
Are there ways around that penalty?
There are exceptions, disability, certain medical expenses, first-time home purchase up to a limit from an IRA, etc. But the general rule is plan to leave it there until retirement age.
I thought with a Roth IRA, you could take out your contributions anytime.
Ah, good point. That's a specific feature of the Roth IRA. Your direct contributions, the money you put in after tax, can typically be withdrawn tax-free and penalty-free at any time, for any reason.
Just the contributions, not the earnings.
Right. The earnings generally still need to stay until 59 and a half to be tax-free and penalty-free. But accessing contributions gives the Roth IRA some extra flexibility.
Okay, so summing it up, the big reason to prioritize these accounts is that tax-free or tax-deferred growth year after year, avoiding that annual tax hit.
Absolutely. That's the core engine. You avoid the tax drag, no taxes on the dividends, interest, or capital gain distributions while the money stays inside the account.
Letting the full amount compound.
Exactly. Which leads us back to that idea of tax drag in taxable accounts.
Yeah, let's dig into that. One source said it might only be like 1.5% or 1.5% a year. It doesn't sound huge. Why does it add up to, potentially hundreds of thousands of dollars?
It's the magic, or tyranny, depending on how you look at it, of compounding over long periods. In a taxable account, even if it's just 1% or 1.5% getting shaved off each year by taxes on dividends or interest.
That money is gone. They can't earn more money next year.
Precisely. It's like skimming cream off the top every single year. The milk that's left doesn't grow as fast. In the tax-advantaged account, all the cream stays in, gets reinvested, and starts generating its own cream. Over 20, 30, 40 years, the difference becomes enormous.
That Reddit example really drove this home for me. The 25K a year, 8% growth, split 4% dividend, 4% appreciation over 28 years.
Yeah, Matchwing's calculation, it's powerful because it's concrete. Let's think about it. If you're getting 4% of your growth from dividends and you're in, say, the 24% federal tax bracket.
You're losing almost a quarter of those dividends to tax each year.
Right. 24% of 4% is nearly 1% of your total return gone right there, just from dividend taxes in the taxable account, before even considering taxes if you sell something.
So your real return after tax is maybe closer to 7% than 8%.
Or even less, depending on state taxes and capital gains. Meanwhile, in the tax-advantaged account, the full 8% stays working for you.
And the final numbers in that example were staggering after 28 years.
The tax-deferred account hit about $3 million. The taxable account, facing that annual tax drag, landed around $2.38 million.
That's, what, $644,000 less?
Yep. Almost 2/3 of $1 million vanished purely because of the tax drag compounding over time. Same contributions, same investments, just held in a different account type.
Wow.
And that white coat investor, quote, backs it up too. Just a 0.5% difference in annual return due to taxes 8%, 5%, and 7.5% means 15% more money over 30 years.
And if the drag is bigger, like 1.5%.
He calculated you could have 130% more money over 6 decades in the tax-advantaged account.
More than double your wealth just from avoiding taxes along the way.
This is really the main point. The power of tax-sheltered compounding is why these accounts are so critical for long-term goals, especially retirement.
Okay, the case for using them is clear. So the next question is how to use them best, which brings us to asset location.
Right. Asset location, it's about being smart about which investments go into which type of account.
To maximize those tax benefits we just talked about.
Exactly. The general idea is to put your most tax-inefficient stuff inside the tax shelters.
Tax inefficient, meaning things that generate a lot of taxable income each year.
Precisely. The classic example is bonds or bond funds.
Why bonds?
Because the interest they pay out is typically taxed as ordinary income. That's often your highest tax rate. So if you hold bonds in your traditional 401k or IRA,
you don't pay that ordinary income tax on the interest each year. It just grows tax deferred.
Exactly. You shelter that highly taxed income stream.
Okay, so bonds go in the tax-advantaged accounts. What else fits that tax-inefficient category?
REITs, real estate investment trusts, are often mentioned.
Ah.
The income they distribute often doesn't qualify for the lower qualified dividend rates that some stock dividends get. It's often taxed as ordinary income, too. So putting REITs in your IRA or 401k shelters that income as well.
Got it. So if the inefficient stuff goes into tax-advantaged, what goes in the taxable account, the tax-efficient stuff?
You got it. And what's generally considered tax-efficient? Broad market index funds, especially ETFs, things like a total stock market index fund.
Why are they efficient?
A couple of reasons. First, they tend to have low turnover. They aren't constantly buying and selling stocks inside the fund, so they don't generate many capital gains distributions that you'd get taxed on annually.
Most of the gain comes from the stocks going up in value, which you don't pay tax on until you sell the fund shares yourself.
Exactly. It's unrealized gain. And when you do sell, if you've held for over a year, you get those lower long-term capital gains rates.
Plus, dividends from U.S. stocks in those funds might get lower rates too.
Right. The qualified dividend rates, which match the long-term capital gains rates.
Yeah.
Much better than ordinary income. So the annual tax bite from holding these in a taxable account is usually much lower than for bonds or REITs.
Makes sense. What about actively managed funds? You mentioned index funds specifically.
Good question. Actively managed funds, where a manager is trying to beat the market by trading stocks frequently.
They probably generate more taxable events.
Often, yes. That higher turnover can lead to more capital gains being realized inside the fund each year. And those gains have to be distributed to shareholders, creating a taxable event for you in a taxable account, even if you didn't sell anything.
So maybe active funds are better off inside the tax shelter too.
That's the common wisdom, yes. Shelter those potentially frequent capital gains distributions.
Okay, so the general rule: bonds, REITs, active funds in tax-advantaged. Broad index funds, maybe individual stocks held long-term, in taxable.
Yeah.
But you mentioned an exception.
A very important one. Municipal bonds. Munis.
Wait, I thought bonds were inefficient?
Regular bonds, yes. Corporate bonds, treasury bonds. But muni bonds are issued by state and local governments.
And their interest is?
Tax-free, at the federal level at least, and often state and local tax-free too, if you buy bonds from your own state.
So the tax benefit is already baked into the bond itself.
Exactly. So putting a muni bond whose income is already tax-exempt into a tax-advantaged account like an IRA, it's redundant. You're wasting the shelter.
You don't need to shelter income that isn't taxed anyway.
Precisely. Hold muni bonds in your taxable account. That's where their tax-exempt status provides a real benefit. And it frees up your valuable tax-advantaged space for things like corporate bonds or REITs whose income would be taxed otherwise.
Okay, that framework seems logical for minimizing taxes.
Right.
But you also said it all depends. Where does it get tricky?
Well, the biggest factor that makes it personal is your own tax situation, especially the comparison between your tax rate now and what you expect it to be in retirement.
This is the traditional versus Roth decision point again, right? Tax rate arbitrage.
Exactly. You're trying to figure out, is it better to take a tax deduction now at my current marginal rate, traditional, or pay tax now at my current rate and get tax-free withdrawals later, Roth?
So if I'm in my peak earning years, high tax bracket.
Traditional looks pretty good, right? Get that deduction when it saves you the most. Let it grow tax-deferred, and hopefully withdraw it in retirement when your income, and thus your effective tax rate, might be lower.
Maybe you're aiming for that 12% bracket in retirement versus 24% or more now, like in the example.
That's the ideal scenario for traditional.
Yeah.
But if you're young, maybe in a lower bracket now, and you expect your income and tax rates to go up over your career and potentially into retirement.
Then Roth seems better. Pay the lower tax rate now.
Often, yes. Pay taxes on the smaller seed amount now at a lower rate and let the entire harvest, including all the growth, come out completely tax-free later, potentially avoiding higher future rates.
But even if the rates are kind of a wash, you still get that benefit of no annual tax drag inside either a traditional or Roth account compared to taxable.
Absolutely critical point. The internal compounding is protected in both. The traditional versus Roth choice is about optimizing when the tax man gets paid. But either is generally better for long-term growth than facing that annual tax drag in a taxable account.
What else messes with the simple asset location rules?
Liquidity needs, time horizon. This is a huge one.
Back to the flexibility of taxable accounts.
Right. If you're saving for something that's not retirement, decades away, especially if it's within, say, the next 5, maybe 10 years.
House down payment,
Yeah.
car, maybe even bridging a gap for kids' college expenses before they hit the usual aid age.
Exactly. You need that money accessible without penalties. Trying to raid your 401k early for a down payment usually means taxes plus that 10% penalty. That hurts.
So for those specific non-retirement medium-term goals, taxable accounts make sense.
They do. Or maybe even high-yield savings or CDs if the timeline is very short and you can't risk market fluctuations. But yeah, the need for penalty-free access drives people to taxable accounts for these goals.
This came up a lot in the discussions around early retirement too. People worry, if I retire at 55, how do I live until 59 and a half without a big taxable account?
It's a super common concern, and historically, it probably led some people to save less in their 401ks or IRAs than they could have, thinking they needed that taxable bridge fund.
But the sources suggest that might be suboptimal, financially speaking.
Often, yes, because you're giving up years, maybe decades, of that powerful tax-advantaged compounding just for the perception of needing liquidity. There are actually ways to get money out of retirement accounts early, before 59 and a half, without the 10% penalty.
Okay, this is important. What are these strategies?
One is called the Rule of 55. It applies to the 401k or 403b plan at the company you're leaving. If you separate from service, quit, get laid off, whatever in the year you turn 55 or any year after, you might be able to take penalty-free withdrawals from that specific employer's plan. You don't necessarily have to wait until 59 and a half.
Okay, helpful if you retire right around 55. What if you want to hang it up earlier, like late 40s, early 50s?
Then you look into SEPs. Substantially equal periodic payments, often called 72T distributions, after the IRS code.
Okay.
This lets you take penalty-free withdrawals from your IRA or other retirement accounts at any age. The catch: the amount is calculated based on your life expectancy using IRS formulas.
So it's a fixed amount each year.
Pretty much. And once you start, you generally have to keep taking those payments for at least 5 years, or until you turn 59 and a half, whichever is longer. You can't just stop or change the amount easily without triggering retroactive penalties.
So it gives access, but it's not very flexible.
Exactly. It's more for creating a steady income stream than for pulling out lump sums for random expenses.
Gotcha. And the third one, the Roth conversion ladder. That sounded popular for early retirees.
It is. It's a really clever strategy. Here's how it works. You take money from your pre-tax traditional IRA or maybe an old 401k, and you convert it to a Roth IRA.
Okay, moving pre-tax money to a Roth. That means you pay tax on the conversion out now, right?
Correct. You pay ordinary income tax on the amount you convert in the year you do the conversion. That's the cost up front.
But then what?
Here's the key. After 5 years have passed since a specific conversion, the amount you converted, the principal, can be withdrawn from the Roth IRA, completely tax-free and penalty-free.
Even if you're not 59 and a half yet.
Even if you're not 59 and a half, the earnings on that conversion still have to wait, but the converted principal is accessible after 5 years.
So the ladder is doing conversions every year leading up to early retirement.
Exactly. If you retire at 50, you can start accessing the money you converted 5 years earlier at age 45. Then the next year, you access the age 46 conversion and so on. You build a pipeline of accessible funds to live on until you hit 59 and a half.
That seems like a powerful way to bridge the gap.
Yeah.
Requires planning to manage the taxes on conversion, but it works.
It really undermines the argument that you absolutely must have a huge taxable account just for early retirement liquidity.
Knowing these strategies exist makes focusing on maxing out those tax-advantaged accounts seem even smarter for the long run.
Definitely. You get the compounding benefits, and you have pathways to the money if needed.
You know, hearing the theory is one thing, but those real-life stories from the Reddit threads really add color. What stood out there?
Oh, so much. It really shows how life happens, you know. Matt Schrink's detailed story was incredible, starting with a modest income, prioritizing debt paydown, then just relentlessly maxing the 401k year after year.
And ending up with over $3 million by 50.
Yeah. Despite having kids, buying a house, it's a powerful testament to just sticking with the plan and letting that tax-advantaged compounding work.
But then you see the other side, like look at the upfront side, talking about daycare costs, just blowing up their savings plan.
Totally. Real life intervenes. Or Green Channel 4328 using a taxable account specifically for potential big kid-related expenses in the high school college years, things that aren't retirement but aren't immediate either, needs that flexibility.
That makes sense.
Yeah.
And there was that interesting bit about not even needing to sell assets in a taxable account to get cash.
Right, the pledged asset line, the PAL that Ranar mentioned, borrowing against your taxable portfolio instead of selling and triggering taxes. It's a more advanced strategy, but shows there are liquidity options beyond just selling.
And I like TBCB's point about balance saving aggressively, but also prioritizing spending on travel and health now. It's not always just about maximizing the final number.
Absolutely. Personal values play a huge role. We also saw some nitty-gritty tactical stuff like the backdoor Roth IRA.
Right, for people earning too much to contribute directly to a Roth.
Yeah, and the complications that come with it if you already have money in a traditional IRA, that pro rata rule Smooth Character 2082 brought up.
Can you quickly explain that pro rata rule? It sounds like a potential trap.
It can be. Basically, if you try to do the backdoor Roth, contribute non-deductible money to a traditional IRA, then convert it to Roth. But you also have pre-tax money sitting in any traditional IRA.
Like from an old 401k rollover.
Exactly. The IRS treats all your traditional IRAs as one combined pool. When you convert money to Roth, they say the conversion isn't just the after-tax money you put in, it's a proportional mix or pro rata share of all the pre-tax and after-tax money in that combined pool.
So if you have a big pre-tax balance, a chunk of your Roth conversion actually becomes taxable.
Yes, precisely. You thought you were converting non-taxable money, but the pro rata rule makes part of it taxable in the year of conversion, kind of defeating the purpose of the clean backdoor Roth.
So people need to be careful about existing traditional IRA balances if they want to do backdoor Roths. Maybe roll those old 401ks into their current 401k instead.
That's often the workaround, yeah. Keep the pre-tax money out of the IRA space entirely. It highlights how you need to know the specific rules.
The core debate kept coming up, though. Is taxable ever better for actual retirement savings?
And the overwhelming consensus from the sources and the math seems to be almost never. Unless there's some really unusual, unavoidable short-term need that the early access strategies just can't cover, the long-term penalty from tax drag in a taxable account is just too severe compared to letting your money compound tax-free or tax-deferred.
Someone even wondered if just paying the 10% early withdrawal penalty might be cheaper than decades of tax drag.
It's a provocative thought, right? And it highlights how significant that drag is. We also saw the observation that, in reality, a lot of people don't follow the optimal asset location rules.
Like holding bonds in taxable accounts.
Yeah, maybe it's complexity, maybe it's just habit, maybe it's prioritizing easy access over tax optimization. But understanding that potential $600 K plus difference might make people reconsider.
Okay, this has been a ton of information. How does someone listening actually put this into practice? Is there a recommended order of operations for saving?
Yeah, there's a pretty standard prioritization sequence, especially popular in Boglehead circles, that makes a lot of sense for most Americans.
What's step one?
Step one, absolutely critical. Contribute enough to your 401k or whatever employer plan you have to get the full company match.
Free money.
It's free money, often a 50% or 100% instant return. Never, ever leave that on the table if you can help it.
Okay, got the match. What's next?
Then typically max out an IRA. Either traditional or Roth, based on that tax rate calculation we discussed. IRAs usually offer more investment flexibility than 401ks.
So 401k up to match, then max IRA. Then
If you have a high deductible health plan and are eligible for an HSA, a health savings account, that's often priority number 3.
why HSAs?
Triple tax advantage. Contributions are pre-taxed or deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. And if you don't spend it on healthcare, you can invest it and eventually withdraw it like a traditional IRA in retirement after age 65. It's an amazing account if you qualify.
Okay, match, IRA, maybe HSA. What's left?
Go back to your 401k and contribute more, aiming to hit the maximum annual employee contribution limit if you can. Leverage that higher limit.
So only after you've done all that max the match, the IRA, the HSA, if applicable, and the rest of the 401k limit. Then you look at a taxable account for extra retirement savings.
Generally, yes. For long-term retirement money, the taxable account comes last in the priority list. You'd use it if you filled up all the tax-advantaged buckets, or if you have those specific, shorter-term, non-retirement goals that genuinely require that penalty-free liquidity.
And even then, be intentional about why you need that liquidity.
Exactly. Really weigh it against the long-term cost of taxes. Is the need for flexibility so great that it's worth potentially hundreds of thousands less in retirement? Could one of the early access strategies work instead if it's for early retirement? It's personal.
Your income, your future expectations, your comfort with complexity, it all plays in.
For sure. And like one person said, don't get paralyzed trying to be perfect. Just saving consistently is huge.
Getting started is key.
Absolutely. But optimizing where you save, using smart asset location, that provides a massive tailwind over your investing lifetime.
Okay, let's try and wrap this up.
Sure. I mean, we've seen pretty clearly that this choice between taxable and tax advantaged isn't just minor details. It's fundamental to how fast your money grows. It's about using the tax code to your advantage.
Right. Those tax-advantaged accounts, the 401ks, the IRAs, they offer this incredible shield against ongoing taxes, letting your investments compound much more powerfully over time. Avoiding that tax drag is the name of the game.
And that drag, as we saw, isn't trivial. It can add up to staggering amounts over decades. The traditional versus Roth decision is important for when you pay tax, but both beat taxable for pure long-term compounding power.
And while taxable accounts definitely have their place, vital for flexibility for shorter-term goals.
For long-term retirement savings, even early retirement, we learned there are established ways like the Rule of 55, SEPPs, the Roth conversion ladder to potentially access funds early without penalties.
Which really strengthens the case for prioritizing those tax-advantaged accounts first and foremost for retirement.
It's complex, sure, and everyone's situation is different, but the math consistently points towards leveraging tax-advantaged growth for as long as possible.
So maybe the final thought for everyone listening is this. If you find yourself heavily favoring a taxable account for your long-term retirement savings, mostly because you value that simple, immediate liquidity,
have you really quantified the potential long-term cost, that compounding tax drag? Hundreds of thousands, maybe more.
And have you explored whether learning about and potentially planning around strategies like the Roth ladder or Rule of 55 could give you the best of both worlds, the powerful tax-advantaged growth and a planned way to access funds if you really need them early?
It's a question worth asking yourself seriously as you plan your financial future.
Definitely something to think about. Thanks for breaking all that down.
My pleasure. It's crucial stuff.
Thanks, everyone, for joining us on this deep dive.
See you next time.